Hello. Today we're going to talk about the value of owner's equity. If you'll recall, we've already talked about just in general what is corporate finance. What do you mean by that? And if you'll recall, that is the science behind making financial decisions, so decisions about money in corporations. And we've talked about what stockholders are and what bondholders are and what equity is and all of that. And so that's sort of a jumping off point to now start talking about the value of owner's equity. Now, the reason we talk about the value of owner's equity at this point is that it's such an important concept in corporate finance. There is an underlying sort of rule or assumption, if you will, in corporate finance that the decisions that are the best decisions for the company to make at any point in time are decisions that would maximize or improve at least the value of the existing owner's equity in the firm. And so if we say that that's really the theme that guides our decision making, then it's important to understand what we mean by the value of the owner's equity in the firm in order to start wrapping our head around this. So, at a very high level, what is owner's equity? You can certainly go Google that, and I think you'll get a lot of different answers. The gotcha on that is that it's sort of defined in a lot of different ways. From a very general standpoint, the way to think about owner's equity is to think about what is a company. So a company is a collection of assets, equipment, land, intellectual property, inventory, cash, all those sorts of things that is assembled in a particular way that it can go out as a business and earn money. And so if you were to take all of those assets and those businesses and sell them, just get whatever money you could get for them today, and then take the money that you got and use it to pay off any debts that you had as part of the business, then whatever's left over would be your owner's equity. And that's quite frankly, that is the simplest way of thinking about it. The complexity, and you'll see this when you go out and look at different definitions of owner's equity, is that there's sort of an accounting view of it, what we call the book value, and there's a finance view of it that's really a market value view. And I just want to clear that confusion up for you. The book value, which you should have seen in your introductory accounting class, is simply the value of assets minus the value of liabilities. Or probably the way you're more used to seeing it is that assets must be equal to liabilities plus owner's equity. So if you kind of rearrange that equation, you'll see that owner's equity is assets minus liabilities. Very consistent with the description that we used on the prior slide, but in this case, the value of assets and the value of liabilities are not what you can go sell them for. So it's not, I've got this collection of assets and how much can I sell them for? Rather, it's how are those assets recorded on my financial statements, right? And so generally they're recorded at the price that you bought them at, not necessarily at what they're worth today. In some cases, that means there's depreciation, but in most cases, you put those assets together in a particular way so that you could use them to create some magic and create value, right? Profits. And so while the individual assets may not be worth much, when you put them together the way that you've put them together, they're worth a lot, usually a lot more than you paid for them. That's the reason why you were okay paying for them. And so book value won't reflect that extra. It will reflect what you paid for them, and it will reflect how much you've earned from them so far. It won't reflect anything about what you could earn from them in the future, just how much you earned from them so far. And then, of course, the liabilities will reflect how much you sold your debt for, but it won't necessarily reflect what it will cost you to retire that debt today. It may cost you a little bit more, a little bit less. So again, it's not a market value of debt, it's just a book value. The key thing from a financial standpoint that we care about with book value is that it doesn't reflect the current price, and it doesn't reflect anything about what shareholders think could happen in the future with the business. It just reflects what's already happened. So it's a very backward-looking view of the company. Market value, on the other hand, is quite simply whatever a willing buyer and a seller would agree to exchange value at. And so that could be market value. In this case, we're talking about for stock or for equity, but it could be market value of anything. If somebody owns a car and they want to sell it, the buyer and the seller will negotiate, and if they can agree on a price that they're both happy with, then that becomes the market value of the car. At that point in time is a transaction happened, willing buyer, willing seller, an agreed upon price, there you go. And only the buyer and the seller of the car know what they took into consideration in deciding that's an acceptable price, right? So we can't see all the things they took into consideration. All we can see is the price. Well, so for a company, the market value of their equity is the current stock price as it's so the most recent transaction price for their stock times however many shares of stock are outstanding. And so it does reflect whatever it is that the buyer and the seller were thinking about whenever they agreed on that price. Usually we assume that it's more forward-looking. It does give the company credit for what it's done in the past, but it adds to that an additional credit for things that it thinks the company will do in the future in terms of earnings and profits and so forth. The big thing about those, a lot of people think they like to compare the market value of a company to its book value, and I think that's fine. You can read too much into that sometimes, but at the end of the day, it is certainly useful to look and see, is the market value higher than the book value, lower than the book value, a little higher, a lot higher? What do you think? And at the end of the day, a company that has a market value that's near its book value, what that sort of signals is that investors don't really expect much from the company in the future. They don't expect it in the future to do particularly well, and so they're only giving them credit for what they've already done. Whereas if the market value is quite a bit higher than the book value, then they're giving them significant credit for things that they hope will happen in the future. Now, one of the things that I asked you guys to do is to pick a company and to go out and find the book value and market value of equity for your company. I did this for Walt Disney. I found their fourth quarter and full year financial statements. Their fiscal year ends in October of 2016, so this goes through October of 2016. I found that by basically Googling Disney investor relations and digging through that. In a separate video, I will walk you through exactly what I did, and hopefully that will help you when you have to find this for yourself. The main thing I want to draw your attention to is it's pretty simple from a book value standpoint. The book value of equity is the total equity. In this case, all of these values are stated in millions, and so it's $47,323 million. So that's the book value of equity. That's a pretty big number. Again, it's made up of all the stock that's been issued, and you've sort of got the full value of that. Let's see. Looks like no preferred stock was issued, common stock was issued, and so you've got the values on that. You've got all the retained earnings that have grown over the period. You had some other losses that got charged against it. You also had here some treasury stock. The treasury stock, sometimes the company will issue stock and then buy it back. When they buy it back, they have to put it into Treasury. And so this is a negative number. It's reflecting the fact that we had to take money out of owner's equity, $54 billion, to buy back some stock to replace it with some other stock. And so there's the shareholder equity, which is really the amount that's tied to the common stock. And then there's this non-controlling interest equity, which really comes to the total equity. We would probably look at the 43 million or billion, as the amount that we would say is the shareholder equity. Alternatively, let's look at the market value. I went out to basically this link by searching on Yahoo Finance for Disney and then looked under statistics, which I apparently can't spell here. But found out that Disney has 1.59 billion shares of stock outstanding, and that the current price, or a recent price, was about $107 a share. Now, stock prices change throughout the day, and even on Yahoo Finance, those will fluctuate. So I'm not expecting you to get to the penny what exactly is the value. Just sort of get in the range of where those prices have been recently, and that'll be fine. Shares, on the other hand, tend to be pretty stable from day to day. Companies don't typically issue new shares every day or anything like that. They issue them very periodically, so that should be a pretty stable number. If I multiply the 1.59 times $107, I get $170 billion. Now, on Yahoo, and again, I'll have a video where I'll show you where I got this as well, but you can either look those up individually, or they actually quote something called the market capitalization of the company, and it's $170 billion. I want to throw out one last value of equity concept for you, and that's the theoretical value of equity. Again, we know that what we really are interested in, and what the management of the company is interested in, is making decisions that will increase the market value of equity. The challenge to that is, while there is that mutual agreement between buyer and seller on the price of a stock at any one point in time, we can't know for certain how they came to that value. And so just seeing those values after the fact doesn't really help us when we're trying to provide advice to management on what things should make the value go up or go down. And so instead what we do is we develop theories for why the value of a stock is what it is, or why it changes in the direction it does, why it goes up or goes down, what sorts of things might cause it to go up or go down. And then we look at how the stocks actually behave and compare them to what they should have done theoretically, and we hope that they line up reasonably well. And if they do line up close enough, if they seem to behave in a manner that's consistent with the theory, then we would say the theory does a good job of explaining the value, and that's nice. That's sort of a good thing by itself. That's a test of whether it's a good theory. That's one of the tests. But the more important test is whether the theory tells us anything about whether or not we should be making decisions one way or another in the company. And so a good theory might be one that says when companies make financial decisions in this particular way, their stock price generally goes up. And then you go test that in the marketplace, and sure enough, most of the times that the companies make decisions that way, the stock prices go up. And so that's useful for us, because we can then go back to management and say, oh, well, if you want to do things that make the value of your owner equity go up, and that's going to go up since the shares outstanding are fairly stable, assuming that those don't change, then it's really about the stock price. Then here is some things that we know that when you make the decisions that way, they typically make the stock price go up. And so, again, what a lot of financial theory and research is geared at on the corporate finance side is helping us answer a management question. If you consider yourself the manager of a business, and you ask the question, if I do X, will that improve the value of owner equity? I want to be able to answer that question for you. And so as we get posed new questions from business, we do more work and more research to help to refine that. That leads us to have another value of equity, which is the theoretical value. And so the reason I bring this up is that while what we're really after is improving the market value of a company, most of what we're going to be dealing with in this class are the theoretical values or the theoretical change in value of the owner's equity in the company, not the market value itself. And so there's sort of this implicit nod that says that we have research that suggests that things that would cause a good theoretical value are also things that would cause a good actual market value. I just want to make clear to you that that's what we're talking about. Anyway, I know that's a little esoteric way to end, but I often have that question, so that's how we're going to wrap it up. Thank you, guys.